And last but not least, a very brief overview of loans. So we've talked so far about checking accounts and saving accounts. Then we've talked about credit cards. Okay, so credit cards, as we mentioned, is it's a kind of form of borrowing. Uh, if you wish to apply for a credit card, you can do so at most banks, either online or in person. You get billed every month, but a loan is a direct, it's a fixed amount which a bank has, if you will, advanced to you um, for a particular purpose which you want to take that loan out for. So a few features of a loan will be when you take it out, you have to pay back the amount borrowed plus interest. So the amount will be paid back and there will be an interest charge on that loan. To get a loan, you have to qualify for the loan. So this goes back to what we were talking about before. With a credit card, getting a credit card at this stage and making sure that it's well managed, well controlled, could be a good way of building up a credit score. And a credit score gives a possibility further down the line to get a loan if you need a loan for a particular purpose. With loans, as well as with credit cards, do your best to minimize the costs and run the numbers to understand before you borrow. Most people will find that banks at some stage in your life will be falling over themselves to lend you money. The fact that you're being offered something doesn't always mean that one should take it. The fact that somebody's offering more money than we need doesn't necessarily mean we should take more money than we need. So it's always best to, again, going back to running this as your personal business, look at your own situation, see how much you actually need if you do come down to taking a loan, and making sure that you have a repayment schedule in your mind, which is realistic as to how you can pay back that money. The fourth point here is the monthly payment. So each time you pay back your loan every month, a part of that will be paying down what we call the principal, which is the amount which you've borrowed. So if you've borrowed $5,000, a part of your monthly repayment will go to reducing that balance of $5,000 every month or with each payment. But another portion of it will be actual interest payments. Think of interest payments as the profit that the lender, in this case the bank, is making by giving you that money. The higher the amount of interest, typically the worse it is, and the lower the amount of interest. When you're going out for get a loan or a credit card, you're looking for the lowest rate possible, typically. And finally, as I mentioned, strong credit helps your chance of getting a loan. I'm going to expand on this point a little bit. Strong credit is very, very important, and we will go through into some tips as to how to build your credit score up in future sessions. But a good credit score is not only good in terms of helping you to get approved rather than being rejected for a loan, but also the terms of the loan are very important as well. Getting a loan at an interest rate of 6% versus an interest rate at 4% can make a huge difference in terms of how much you're paying back every month. And having a higher credit score helps you to go down and get a lower rate of interest. So it means essentially what you're paying back every month is less than it would have been if you didn't have such a good credit score.